Yeah, so welcome to tonight's class. So what we're going to do, we're going to continue reading the question, but we're only going to read up until intercompany transactions. So tonight we're going to focus on the intercompany of inventory. So I'm going to take it a bit slow so that you can see the full picture and how to understand how it actually works. So I'm going to switch over now to to share my screen, and then we're going to read through the scenario up until intercompany transactions. Okay, so you should be able to see my screen. So you can see Great House Items, which is GHI. So they say ABC acquired 30% of the ordinary share capital of one of its suppliers of household goods on 1 September 2017 for a cash consideration of 510,000 Rand. ABC exercised significant influence over the operating and financial policy decisions of GHI from that date. You can correctly assume that goodwill arose on the acquisition. So as you can see, we exercise significant influence. So therefore if we have an associate, so therefore we have to equity account. Okay, so just take note of that. So GHA had the following equity balances at the date of acquisition of 1 September 2017, share capital 100,000 and retained earnings 1.5 million. So they say all the assets and liabilities of GHI were deemed to be fairly valued at the acquisition date, except for equipment with a carrying amount of 100,000 Rand and a fair value of 30,000 Rand. The remaining useful life of the equipment was determined as 3 years and the residual value at null at that date. Okay, so here you can see there's a fair value adjustment that needs to take place. Is a 30,000 Rand adjustment. So they say the profit after tax of GHI was 205,000 Rand for the 2019 financial year and 185,000 for the 2018 financial year. The group accountant of ABC, a chartered accountant, has uncovered that the management of GHI is overstating its interest earned from other group companies in order to boost its net profit. When the accountant approached the management of GHI, they stated that it is only temporary and that the entries will be reversed in future years as the economy recovers. The accountant accepted the reasons provided and did not pursue the matter further. Okay, so that is like obviously there's an ethics issue that we'll have to take into account. Okay. So intergroup transactions, that's what we're going to focus on tonight. Okay, so they say ABC has been purchasing household items from GHI since 1 September 2017 at a profit markup of 20% on sales. Okay, so here's now a few important things. Number one, it is the parent buying from, so the parent is purchasing from the associate. So what's important to take note, it is the associate that is making the profit, okay? Because the parent is buying from the associate, or put another way, the associate is selling to the parent. Therefore, the one who makes the sale, that is the one who has the profit. Okay, so that's very important. The second thing to take note is that it is a profit markup on sales. Okay, so that's important. You can get a markup on cost and you can get a markup on sales. So be aware of that. And then they say ABC also purchased food products from DEF since 1 March 2018 at a profit markup of 30% on costs. So once again, it is the parent buying from the subsidiary, or the subsidiary is selling to the parent. Therefore, the profit is sitting in the subsidiary. Okay, very important. Second thing to take note, the markup is on cost. Okay, so just be aware of that. So they say the following information relates to these transactions. So year ended 28 February 2019 and year ended 28 February 2018. So meaning it's the current year and the prior year. So sales from GHI to ABC. So the sales from GHI to ABC, you can see it's 200,000 and 190. And then the sales from GHI included in ABC's inventory is 25 and 30. Then for sales DEF to ABC, nothing in the prior year. There's nothing in the prior year, but there is 320 in the current year, and the inventory on hand in the current year is 40,000 Rand. Okay, so that is what I'm going to focus on now. So I'm going to switch over into Excel, and then we will work through this slowly. I'll first start off with the subsidiary, and then once we use the subsidiaries, the understanding of a subsidiary as a base in order to work through the intercompany from an associate point of view. Okay, you should be able to see Google Sheets. Just tell me if you don't. Okay. So we're gonna do so let's actually go to the required. Let me just quickly go to the required. So the required is asking us I'm gonna do part C. The required in part C says, prepare only the pro forma journal entries relating to the intergroup sales of inventory by Delicious and Great Wholesale, two awesome brands in the consolidated financial statements for the year ended 28 February 2019. Journal entries relating to deferred tax are also required. Okay, so let's have a look. So this is how we're going to go about doing this. Okay, so remember we're doing journal entries for the year ended. So it is journal entries for the year ended 28 February 2019. I'm going to separate it just so that you can see the difference between the two. Okay, so when it comes to inventory, intercompany inventory, there's basically 3 journal entries that gets processed. Okay, so when we deal with intercompany inventory, so for intercompany inventory, there's basically 3 journal entries. Number 1, you eliminate the current year sales. Okay, so number one, you eliminate the current year sales. Okay, number two, you eliminate the unrealized profit included. You eliminate the unrealized profit included in eliminate unrealized profit included in where now? In closing inventory. Okay, in closing inventory. Okay, so that's important. Journal entry number 3, you only do journal entry number 3 if there was closing inventory in the prior year. Okay, so for example, for DF, there was no closing inventory on hand in the prior year, but there was closing inventory on hand for GHI. So we'll do all 3 for GHI, but only the first 2 for DEF. Okay, so then we eliminate and recognize, eliminate and recognize unrealized profit included in opening inventory. Okay, so that is basically what you will do. Okay, then yeah, so that is so let's focus on that for now. Okay, so we're gonna do DEF. The easy one is always to eliminate sales. Okay, so remember, intercompany sales, we will eliminate. The reason being is, from a group perspective, you only want to show sales from those outside of the group. So any sales that is within the group, that we want to eliminate. So a sale between DF and ABC that is inside of the group, therefore we have to eliminate it. So to eliminate sales, you are reducing sales. Okay, sales is reduced on the debit side. So we will have debit, credit. So we're gonna have, we are reducing sales. So we're gonna debit sales. Because remember, by reducing sales, you debit sales, and sales was 320. You can just check if I have the right numbers. It was 320, and remember, sales is P&L. For every debit, there must be a credit. So what we're gonna do, so this, we're eliminating the sale, but we're also eliminating the purchase. So the way purchases are brought into account is through cost of sales. So what you're doing, you are reducing purchases. By reducing purchases, you are reducing cost of sales. To reduce cost of sales, you have to reduce an expense, because cost of sales is an expense. So if you're reducing cost of sales, you're reducing an expense. If you are reducing an expense, profit or loss increases. An increase in a profit or loss increases equity, equity increase on the credit side. Just check that if sales was 320, I think it was 320. So we are just saying debit. We are simply saying debit sales, credit, cost of sales. Okay, and both is going through profit or loss. So as you can see, the impact on profit or loss is 0, because you are decreasing profit or loss by 320, then you are increasing profit or loss by 320. So the impact on profit or loss is 0. So why do we do this journal entry? Well, this is only for disclosure purposes. And remember, the sales number in the financial statements, profit or loss is a critical number. So to avoid companies from overstating sales, we eliminate sales. Okay, because remember, many people, analysts, investors, and so forth, they all look to the sales figure. So therefore, we don't want sales to be overstated. Even though this journal entry has no impact on profit or loss, the impact on profit or loss is zero, but the whole purpose over here is to ensure that line items are not overstated. Okay, so that is the first journal entry. Now, for each journal entry, you must ask yourself two questions. You must ask yourself, is there a deferred tax impact? And then the second question is there an NCI impact? Now, to answer the first one, is there a deferred tax impact? There will be a deferred tax impact if there's an impact on profit or loss. As you can see over here, the impact on profit or loss is zero, meaning there's no impact on profit or loss. Therefore, there won't be deferred tax. Okay. The second question is there an impact on NCI? So for there to be an impact on NCI, you must answer two questions. Is there a change in profits? Like in this case, the answer is no. So then there won't be NCI. But if the answer was yes, the second question you need to ask yourself is, did the transaction arise in the subsidiary? So in this case, the subsidiary made the sale. So that means the transaction did arise in the subsidiary. So if there was an impact on profits, then you would have to impact NCI because the transaction arose in the subsidiary. Okay, but we'll see it soon. So for this journal entry, there will never be tax. Okay, so there won't be a tax impact. And as a result, because there's no impact on profit, there also can't be an NCI impact. Okay, now we're going to do the second journal entry. The second journal entry is to eliminate unrealized profit included in inventory. So remember what's happening over here. So just to make it simple, DEF sold inventory to ABC, and the amount of inventory that they sold was 320,000 Rand. Of the inventory of 320,000 Rand, 40,000 Rand is still sitting in the books of ABC. ABC still have that inventory. Now, because that inventory has not been sold outside of the group, that inventory includes a profit that DEF made on ABC. Remember, DEF is charging a 30% markup. So included in that 40,000 Rand inventory on hand is a 30% unrealized profit. Remember, that profit is not realized because that profit is an intercompany profit. So therefore, we have to eliminate it. So what is happening at the moment? ABC's inventory is overstated. ABC's inventory is overstated by the unrealized profit. So what needs to happen to inventory? We need to decrease inventory. Inventory is an asset. Therefore, we have to decrease an asset. An asset decreases on the credit side. So what do? I say inventory, SFP, and I don't remove 40,000. I only remove the unrealized profit included in the 40,000. So remember, the unrealized profit is 30 over 130. So when it's markup on cost, then you say markup divided by 100 plus markup. Okay, so this is 100 plus markup. So it's 100 plus 30. That is why I got 130. So when it's markup on cost, it is 30 divided by 100 plus markup. Okay, so it's 30 multiplied by 40,000 Rand. So remember, included in the 40,000 Rand is a 30% markup. So that is overstating inventory. Therefore, I need to decrease inventory. So what do? I say 30 divided by 130, 30 divided by 130 multiplied by 40,000. Just make sure I'm using the right numbers. The 40,000, I think 40,000 is for DEF. Okay, Then for every credit, there must be a debit. The debit is going to go against cost of sales. Remember, everything with inventory generally goes against cost of sales. But why does it also make sense that it goes against cost of sales? Remember what we're trying to do. We're trying to eliminate the unrealized profit. So by debiting cost of sales, if you are debiting cost of sales, it means you are increasing cost of sales. If you are debiting cost of sales, it means you are increasing cost of sales. An increase in cost of sales is an increase in an expense. An increase in an expense reduces profit. Now remember, you're trying to eliminate unrealized profit. By eliminating unrealized profit, you want to reduce profit. So that's why you can see it does make sense to debit cost of sales. Now we must do the next part. The question of, is there deferred tax? There will be deferred tax if there is a change in profit, if there is an impact on profit. As you can see, there's a debit to profit and there's a credit to the balance sheet. So like in this case, there was a debit to profit and a credit to profit. So the impact on profit was 0. But in this case, it's only one transaction going through profit. So that means profit is being impacted. Profit is being reduced. If profit is being reduced, income tax will be reduced. Now, if you're reducing income tax, you are reducing an expense. So remember, the cost of we are debiting cost of sales. So that means cost of sales is increasing. A debit to cost of sales is increasing cost of sales. Cost of sales is an expense. That means an expense is increasing. An increase in an expense decreases profit or loss. Okay, so that is why when I'm thinking about income tax, I'm saying profit or loss is decreasing. So if profit or loss decrease, income tax must decrease. Income tax is an expense. Therefore, expenses are decreasing. A decrease in an expense increases profit or loss. An increase in profit or loss increase equity. Equity increases on the credit side. So that is why I'm going to say credit income tax P&L. For every credit, there must be a debit, and the debit will go against deferred tax balance sheet. Okay, so the deferred tax is simply going to be 28%. Okay, so I'm just going to say that times 28%. So you will use your accounting tax rate. Okay. And lastly, we need to ask ourselves, is an impact on NCI? For there to be an impact on NCI, two criteria must be met. Number one, there is an impact on profit. So we know there's an impact on profit. So criteria number one is met. Criteria number two, did the transaction arise in the subsidiary? And the answer is yes, the transaction did arise in the subsidiary because the subsidiary made the sale. So as a result, because the subsidiary made the sale, the transaction arose in the subsidiary, therefore NCI will be impacted. So remember, overall profit or loss went down. Because profit or loss is decreasing, NCI will decrease. NCI is equity. Equity decreases on the debit side. So I'll say debit NCI, equity, or you can call it equity or SCE, statement of change in equity. And for every, so you just say NCI P&L. Okay, so you always think about in terms of the equity balance, because profit or loss is decreasing, NCI's portion, NCI will share in the decrease, so NCI's is decreasing. NCI's equity decreased on the debit side. So what do? We just basically take the difference between that. We take the difference between tax. So we're going to say that going to say equal that minus the tax, and NCI was, I think, 25%. Okay, so that is NCI's portion. So NCI is decreasing by 1,661. Okay, so just take note of that. So what's important to take note, the way you think about it, when you do a journal entry, don't confuse tax and NCI. First, deal with the actual intercompany. First, deal with that. Once you deal with that, now you ask yourself, is it a tax impact? Is it an NCI impact? Then you deal with that. First, do the journal entry. Then you ask yourself, is there a tax impact? Is there an NCI impact? That's what I did. I first did the journal entry, and I ignored tax, I ignored NCI. Once I got this right, now I ask myself, okay, is there a tax impact? Is there an NCI impact? Similarly over here, I first did this journal entry and I ignored income tax and I ignored NCI. Once this entry was done, now I ask myself, is there a tax impact? Is there an NCI impact? Okay, so that is a thought process to work through. So take note over here, we removed everything at 100%. Okay, the reason being is we're dealing with a subsidiary. Because we are dealing with a subsidiary, everything is done on a line-by-line basis, and we account. Consolidations mean we bring on 100% of the subsidiary's income and expenses on a line-by-line basis. So because 100% is in our books, we need to eliminate the full intercompany transaction. So just take note of that. Now, using this as a base, using this thinking as a base, we're now going to deal with from an associate point of view. Remember, with an associate, we equity account, we don't consolidate. Okay, so remember there was an intercompany transaction. There was also a sale, an intercompany sale, and the intercompany sale was in the current, we only remove the current year's intercompany sale. So the intercompany sale of the current year was 200,000 Rand. So like above, journal entry number 1, eliminate the current year sales. Eliminate the current year sales. So when I eliminate the current year sales, I'm going to do this. So we're in a 200,000. Okay. Now we need to understand something. What's important to take note over here is the following. The journal entry as is not correct. Okay, I'm just doing it. There's a reason why I'm doing it that way, just to show you my thinking so that you don't get confused. Okay. So what's important to take note is the following. What's important to take note is the following. Let's just do now. When it comes to an associate, and this is very, very important, okay? This is extremely, extremely important. They don't take this lightly, okay? With a subsidiary, we consolidate. So consolidation means we bring on 100% of the subsidiaries' assets, liabilities, income, and expenses on a line-by-line basis, okay? And that is why we can say sales and we can say cost of sales. With an associate, we equity account. With an associate, we equity account. Equity accounting means we only bring on our portion of the associate, and we do not bring it on a line-by-line basis. We bring it onto our books in the income statement through one line item called share of associates profits. So basically, this over here can't be called sales because we don't bring on the associates sales. We don't bring the associates books on a line-by-line basis, but rather we include it in the group books by one line item called share of associates profits. Similarly, we don't bring on cost of sales on a line-by-line basis, so we call it share of associates profits. What we want to do, we don't bring on 100%, we only bring on our portion. So therefore we say multiply by 30%, and we say over here, well, because we only bring on our portion, we have a 30% interest, so we multiply by 30%. As you can see, what is happening over here? We are debiting share of associates profits, and we're crediting share of associates profits. So there's no impact on the one line item called share of associates profits. Therefore, this journal entry is not performed from an associate point of view. Okay, so that's very, very important to take note. So I'm going to strike it through because we don't do that journal entry. That journal entry is not applicable. I only did it to walk you through this process, eliminate current year sales. So now I'm eliminating current year sales. And remember, this is the associate making the sale. Okay, that's very important. This is the associate making the sale. So the associate is making the sale. So therefore, we need to say debit sales, credit cost of sales, relating to the associates books. But we don't bring on sales and cost of sales as a line-by-line item onto our group books. We only bring on the associate in one line item called share of associates profits. So therefore, included in share of associates profits is sales. Included in share of associates profits is cost of sales. So as a result, we need to say debit sales through share of associates profits, credit cost of sales through share of associates profits. So as you can see, there is absolutely no point of doing this journal entry. So that journal entry is not applicable. Okay, very important to take note. Now we go on to the second journal entry. Eliminate unrealized profit included in closing inventory. We know there was closing inventory of 25,000 Rand. So we do the same journal entry as we did above. We do the same journal entry as we did above. So remember, the parent's inventory is overstated. The parent's inventory is overstated because included in the parent's inventory is 25,000 Rands worth of inventory that was bought from GHI. And included in that inventory bought from GHI is an unrealized profit. So therefore, we need to eliminate the unrealized profit included in the inventory that is sitting in the books of the parent. So therefore, because we bring on the parent at 100% on a line-by-line basis, the parent's inventory will be included in the group's inventory. So the group don't want that unrealized profit. So therefore, we need to decrease. We need to eliminate the unrealized profit included in inventory. Eliminating a profit means we must decrease inventory. Inventory is an asset, therefore we are decreasing an asset. An asset decreases on the credit side. So to eliminate it, remember it was 20% on sales. So we say 20 divided by 100. So take note, when it is on cost, it is 130. When it is on sales, it is 100. Okay, so just be aware of that. So it is that times 25,000 Rand. But now remember, this is not a subsidiary. This is an associate. So we only need to account for our portion. So therefore, we also multiply by 30%. As you can see over here, we didn't multiply by our percentage from when we did with the subsidiary, because we bring on the subsidiary at 100%. Therefore, we eliminate the full amount. For an associate, we only eliminate our portion. So therefore, we say, because only our portion is intercompany. Okay, that's very important. Only our portion, only our 30% interest in the associate is intercompany. So that's important to take note. So it is 20 divided by 100 times 25,000 times 30%. For every debit, for every credit, there must be a debit. Now, this debit is cost of sales, and this debit refers to the cost of sales of the associate. Why is it the cost of sales of the associate? Because it is the associate that made the profit. It is the associate that made the profit. So the cost of sales, is the associate's cost of sales, because the unrealized profit is sitting in the books of the associate. But like we mentioned above, we can't use cost of sales because we don't bring on the associate on a line-by-line basis. We only bring on the associate in one line called share of associates' profits. So whenever you want to impact the profit line item of an associate, you can't use the actual line item. You have to use the terminology called share of associates' profits. Okay, very, very important. Okay, so that's extremely, extremely important. Yes, Walter.
If I just wanted to ask something. So by debiting share of profit, does it mean that we are reducing our share of profits from associate?
Correct.
Okay, it's okay. Then can you kindly guide us again with regards to the margin and markup, the 30% and the 20 over 100? Okay. The other one is used on cost and the other one is used on what?
So when they say the markup is on cost, then you say 100 plus the markup. So that's why my denominator is 130. The 100 plus markup of 30 gives me a denominator of 130. So always remember, when it is markup on cost, your denominator will simply be 100 plus markup. When it's on sales, your markup is the denominator will only be 100. Just follow that rule. So it doesn't take a bit of time to go into the explanation thereof. Okay, so we're okay with that? Okay, so that is journal entry number 1. Okay, I'll deal with deferred tax after this. There's going to be deferred tax. So you can see there will be deferred tax. Okay, let's just do deferred tax. So what's going to happen? We need to adjust for deferred tax. So what we're going to do, we are debiting share of associates' profits as a result of deferred tax of unrealized profits. So we're going to have to credit share of associates' profits relating to income tax, share of associates' profits. And then this will be deferred tax. It's the same thing as this over here. It's the same thing as this over here. There's deferred tax balance sheet. We want to say income tax P&L, but we can't say income tax because we don't bring on the associate on a line-by-line basis. So when we want to impact the associate's income statement, we impact it through the line item called share of associates' profits. Very, very important. So once again, we simply get, this is already at 30%, so it's fine. We just take that multiplied by 28. Okay, now we're going to do the last journal entry. So the last journal entry is eliminate and recognize unrealized profit included in opening inventory. So we have to do a journal entry relating to opening inventory. Okay. So the journal entry relating to opening inventory would be as follows. We're going to debit retained earnings. And this is going to be equity. And we're going to credit share of associates profits. Okay, so we're going to credit share of associates profits. So let me just explain this. The credit, so what you must understand is that when we do group accounting, we always prepare pro forma journal entries from scratch. So this year, we're going to prepare pro forma journal entries from the date of acquisition up until the end of the current year. Next year, we do the same thing. We prepare the pro forma journal entries from scratch. We start from at acquisition and we do it up until the current year. And the following year, you do the same thing. So the important thing is that every single year, you prepare pro forma journal entries from scratch. So as a result, when we are doing this year's journal entries, we need to eliminate last year's unrealized profit. Okay, we need to eliminate last year's unrealized profit because last year that was last year's closing balance. Okay, but now this is the second part to it. Last year's closing balance. So there's two parts: eliminate and recognize. Okay, so the first part is eliminating. What are we eliminating? We're eliminating the unrealized profit relating to last year's closing balance. Okay, so that is what we are doing. Then the second part is last year's closing balance becomes this year's opening balance. Now, it is an assumption that this year's opening balance has been sold. Okay, so because this year's opening balance have been sold, it means we have realized the profit. So therefore, we will recognize share of associates profits. So by crediting share of associates profits, you are increasing share of associates profits. Why? Because we are saying last year's closing balance is this year's opening balance. And the unrealized profit, including in this year's opening balance, is assumed to have been sold. So we are assuming that we have sold the opening balance and therefore the profit has been realized. Remember, even if we didn't sell it, it would be captured in this year's closing inventory. And that is why we have to assume that last year's closing balance, which is this year's opening balance, have been sold. Otherwise, we're going to be double counting the unrealized profits. So that's very important. So what we're going to do over here, we're going to realize the profit included in last year's closing balance because that is this year's opening balance. And we assume that all inventory in this year's opening balance have been sold. And as a result, the unrealized profit now becomes realized. So remember last year's closing balance was 30,000, I think. So we follow the same principle, 20 divided by 100 times, I think it's 30,000, you can just double check for me, times 30%. So all we're going to do, we're going to say 20 divided by 100 times 30, 123 times 30%. Okay, so that is that. And then we have that over there. I'll try to find a video where I go a little bit more detail in this explanation. Then I'll send it to you guys. Now we have to do deferred tax, and deferred tax would simply be you just swap them around. Okay, so this will be share of associates profits, and that will be retained earnings. And we'll just simply say that multiplied by 28%. So let me just try to explain to you why this makes sense, okay? I don't have to go find that video. So let me just explain why it makes sense. So I'm going to explain this journal entry over here, okay? So what you must know is the following. What you need to know is the following. That the first part is to eliminate last year's closing inventory. Unrealized profit in last year's closing inventory. Now remember, what we would do, we'd have simply done the following. We'll simply process this journal entry. We'd have simply processed, last year, we'd have processed this journal entry. Okay, I just want to get the amount. It's going to be the same amount. Okay, so it's going to be the same. It's going to be the same amount. Okay, this is the same thing. So last year, we would have processed this journal entry. Okay, now this year, we have to reproduce this journal entry because every single year we do journal entries from scratch. For pro forma journal entry, we do it from scratch. So last year we did this journal entry. Now this year we need to reproduce this journal entry. Why? Because we do pro forma journal entries from scratch every single year. However, this share of associates profits refers to the share of associates profits of last year. Last year's share of associates profits no longer exists. It has been closed off. Where did we close off last year's share of associates profits to? We closed it off to retained earnings. Okay, so we closed it off to retained earnings. So that changes to retained earnings. Whenever you're dealing with an income statement, whenever you are dealing with an income statement amount from a prior period, you can't call it the income statement line item because that line item no longer exists. Because remember, an income statement is closed off to retain earnings or to revaluation surplus and so forth. So last year's share of associates profits don't exist because it has been closed off to retained earnings. So therefore, we don't call it share of associates profits, we call it retained earnings. Then we need to do the next part. We need to do the recognize. So remember, this over here is reproducing last year's closing inventory unrealized journal entry. But last year's closing inventory became this year's opening inventory. So we must assume that this year's opening inventory have been sold, and as a result, the profit included in the opening inventory have been realized. So because the profit have been realized, we are going to say credit cost of sales. We're going to say credit cost of sales. For every credit, there must be a debit. The debit always goes against inventory. Okay. So here we have SFP, here we have P&L, same amount. And now remember, we can't call it cost of sales because the cost of sales refers to the cost of sales of the associate. And we don't bring on the associate on a line-by-line basis. We bring on the associate through the income statement of the associate through the line item called share of associates profits. So if we look at the two journal entries in together, there is a debit retained earnings, credit inventory. Debit inventory, credit share of associates profits. So all we are doing is the debit, the credit to inventory, and the debit to inventory gets eliminated. So the debit and the credit inventory gets eliminated. So we are left with retained earnings, debit retained earnings, and credit share of associates profits. Credit share of associates profits. And as a result, the deferred tax follows. Okay. If you do the journal entry like this, you'll get 100%. Okay. They don't worry. They don't mind which way you do it. Okay. So that's all I want to cover for tonight. I don't want to do some more stuff. So I'm going to end over here so that you can work through this and try to get a good grips of it. So if there's any questions, you can ask me. If there's no
on this one, the 1.8, I was trying to read through the question. Where am I supposed to go? Like the 30,000. I wanted just to see where is it in our scenario.
In the scenario 20, so under intergroup.
Yes.
I think there's 130,000. Yeah. Intergroup. So you will see 28 February 2018. And you can see sales from GHI including ABC's inventory on hand, 25 and 30. So 25 is the current year. And so that is including the closing balance of a current year. And then 30,000 is last year's closing inventory, which becomes this year's opening inventory.
Okay. So in terms of our journal that we're doing now, for the 30,000, we are saying we are debiting retained earnings with the associate share of profits, accounting for the past year. So if it means now, okay, this is associate, I wanted now to say if it was now I'm now consolidating, it means I have to remove this 1.8 from the associates retained earnings.
Yes.
Okay. No, that's fine. Thank you.
Is any other questions?
Wi-Fi's?
Yeah.
I just wanted to ask if you could maybe next time show us in maybe statement of changes in equity, how it's handled with regards to this one.
So our next lesson will be on Saturday, right?
I assume so. I wouldn't know.
Yes, I think that should be Saturday.
Okay, that's fine.
All right.
Okay. So I'll send you out this video by tomorrow. Okay, then you can work through it and see if there's any question that you have. I will look for statement of changes in equity. It's a little bit difficult to find one for without change in ownership, because generally you need to test change in equity when they do change in ownership, but I'll look and I'll see if I can find one. Okay.
All right. Thank you very much, Vice.
Okay. Thank you, guys. Bye-bye.
Thank you.
That's fine.
Bye-bye.